Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill, your host. Later on, I will be speaking with Sam Hodges, Co-Founder and United States Managing Director of Funding Circle. And Funding Circle is a great big deal in peer-to-peer lending. But first, let us speak of investing in agriculture. I live in Chicago, and when I drive through the rural Midwest, I like to listen to AM radio and grab local newspapers so that I can learn about things people do that I don't do and concerns that they have that I don't necessarily have. When you're in corn country, a whole lot of radio programming and a whole lot of newspaper editorializing is in favor of federal biofuel mandates. Biofuels being used for cars and other things, often generated from corn. Of course, biofuel mandates distort the market in favor of higher demand for corn. If there's higher demand for corn, there will be a higher demand for suitable cropland and therefore an increase in land values throughout the Corn Belt, and this we have seen. Now, this made me think, or at least it makes me think when I think about it, that many economists and market watchers believe that markets price information very, very quickly, faster than an amateur investor can. And then one thinks, wait a minute, the fortunes of the Corn Belt are tied to federal policy and changes in federal policy toward biofuels. Two of the principal examples of these changes in federal policy are the Energy Policy Act of 2005 and the Energy Independence and Security Act of 2007, both laws passed by Congress and signed by then-President Bush. Could an investor who was paying attention to these laws as they were coming on board have gotten in on the ground floor, so to speak, of Corn Belt land prices? Well, that's a question. I don't know the answer. If you have the answer, please email me, ccahill@financialpoise.com. That's ccahill@financialpoise.com. One thinks a little further about investing in agriculture. One recognizes that the market for Corn Belt land is really only one small part of the story of investment opportunity in agriculture. Right now on www.AIMkts.com, we have an article entitled "A Few Minutes with Kate Westfall," the Senior Director of Content, Global Ag Investing, and Event Director of GAI AgTech Week. Now, I call that an article, but it's really a written interview. And in this written interview, Ms. Westfall discusses how, since the financial crisis, agricultural investment conferences have proliferated and the number of participants therein have multiplied. And it almost goes without saying that investment in agricultural things can diversify a portfolio. Of course, it depends upon what the rest of your portfolio is like, but agricultural tends to provide a counter market kind of effect on your portfolio. And like many commodities, can give you an inflation hedge. At the foot of the A Few Minutes with Kate Westfall written interview, the editors of Accredited Investor Markets provide links to 4 other articles on the site that have to do with agricultural investing and aquacultural investing. They also provide a link to an AIMkts radio interview with Charles Smith that I conducted. Charles Smith is the managing director of Pegasus Intellectual Capital Solutions and was raised as a farmer in Iowa. So we had all kinds of fun, Mr. Smith and I, comparing his upbringing, which was very similar to that of Fern in E.B. White's Charlotte's Web, with the realities of Midwestern agricultural today. And of course, that talk ranged into aquaculture as well, a very exciting field from the investment perspective, maybe not from the aesthetic perspective for those who love Charlotte's Web. Well, let's move then from crops to tats. The American Association for the Advancement of Sciences publishes the esteemed journal Science. Their website also hosts Eureka Alert. All one word, as is the style these days. It combines the words Eureka and Alert, so it's Eureka-A-L-E-R-T, the A serving as the end of Eureka, at the same time serving at the beginning of Alert. So Eureka Alert, an informational website. And on that website is an article dated May 27, 2015, entitled, Getting Inked May Cause Long-Term Medical Risks, Physicians Warn, end quote. The physicians are researchers at New York University. New York and tattoos. I guess if you've been to New York any number of times, you'll know that in some of the trendier neighborhoods in Brooklyn, fully 100% of people get inked. Now, that's not in the article. NYU did not say that. I say that from my own personal observation. But the researchers do say that 6% of those who get inked experienced, quote, tattoo rash, end quote, which they defined as severe itching and swelling that lasted longer than 4 months, in some cases, years. And that raises the question, of course, and maybe this is just the father in me talking, is it really worth it, given the risk of tattoo rash, the 6% risk of tattoo rash? Is it worth it to fit in, to get tattoos, to fit in, to get a date, to keep a trendy job, to not get ridden out of Williamsburg, Brooklyn on a rail, or to update that metaphor, to avoid getting hounded out of Williamsburg, Brooklyn, on some sort of social media forum that I'm too lame to have heard of yet? By the way, the researchers say that anti-inflammatory steroids or maybe laser surgery can set you right, maybe more intrusive surgery. In conclusion, the researchers stated, and I'm going to quote here, quote, the skin is a highly immune-sensitive organ, and the long-term consequences of repeatedly testing the body's immune system with injected dyes and colored inks are poorly understood. And here I'm going to insert a ... and close the quote, because no one's listening any further. Certainly nobody in Williamsburg, the 100% who have tattoos there, or the 20 to 50% in the Corn Belt, to bring this full circle, who likewise have tattoos, because 6% chance of a tattoo rash that may be quite mild doesn't sound all that earth-shattering. But I've got to hand it to the NYU researchers and to Eureka Alert for publishing work based on scientific research that makes such a modest claim. I mean, how boring is it, what they came to? But it's nice to see that, instead of the scientific flim-flam one sees throughout the media, including with respect to excitements over scientific-oriented startups and so on. I have to, at this point then, with regard to scientific flim-flam, leave you with a recommendation of one more article. I won't discuss it. I'll just tell you its title and where to get it. It's very long and very good if you're a bit of a geek. And it's called The Trouble with Scientists, How One Psychologist is Tackling Human Biases in Science, written by Philip Ball, dated May 14, 2015. Where do you find it? You find it on the Nautilus website, which is nautil.us. Or if you just look for the title of the article and the fellow's name, Philip Ball, The Trouble with Scientists, you should be able to find it. It's a searching article about scientific flim-flam. With that, let's get to the interview. Hello and welcome to Accredited Investor Markets Radio. I am Christopher Cahill of Accredited Investor Markets Radio. With me today is Sam Hodges, who is co-founder and U.S. Managing Director of Funding Circle, a peer-to-peer lending company. Sam co-founded the company in 2012 after seeing how hard it was to get a loan for a small business, which was a successful gym franchise, which he had helped to build. Funding Circle has grown and now is the world's largest online marketplace exclusively focused on small business loans. Sam oversees the strategic direction and day-to-day operation of Funding Circle in the United States. Before co-founding Funding Circle, Sam served as Vice President of Business Development at Second Market, a leading marketplace for alternative investments. Sam was also part of the investment team at P2P Capital, an $8 billion global fund manager, where he covered investments in financial technology and information services. Welcome to the program, Sam.
Thanks for having me on the show, Chris.
So tell us about the gym. Were you in the gym and you had a eureka moment regarding small business lending?
Well, not quite, but close. Along with some partners, we've built up a successful chain of Snap Fitness locations. We actually have 5 gyms all over the country, and then more recently actually have added a couple of spin studios as well. And it was really in seeing how hard it was to get a bank loan for those small businesses that we realized there really is just a gaping hole between where consumer credit taps out on one end and where banks are really interested to lend on the other. And so it was kind of in experiencing that pain point, and then also realizing that there are many investors, individuals and institutions, who are really looking for great, strong yielding investment opportunities that we kind of put 2 and 2 together and decided to form what now is Funding Circle.
So you still have the gyms?
We do, yeah. I'm not active in running them day to day, but a number of my partners are, and the business continues to grow and expand. Have, again, 7 locations kind of all over the country, and it's been really exciting to see that succeed.
How bad. Now, you used the metaphor of a gaping hole. Has that gaping hole gotten wider since 2012?
So if anything, it's actually gotten wider, and I say that for 2 reasons. The first of which is the pace of bank lending under $1 million in loan size continues to fall year over year. So if you think about the total amount of new capital lent out versus the amount of inflows that banks are getting from the return of principal and interest paid back to them by their borrowers, it's really a negative number. And so the amount of smaller loans that are outstanding and also the pace of new loan origination both have gone down. The second thing is the U.S. economy is growing. There are lots of great small businesses that are getting started. They want to add jobs and employment, and if anything, that creates an additional layer of, if you will, pent-up shadow demand for great loans. And other than Funding Circle and a few others, no one's really meeting that need.
Well, let's talk a little bit about, but not at great length, about why is the pace of bank and other official intermediaries lending under $1 million slowing so much, do you think?
Sure. I think it comes down to 2 pretty interrelated factors. The first of which is, over the last 20 years, you've seen a meaningful contraction in the number of banks in the United States. From approximately 12,000 different depositories at the beginning of in the year 2000 down to about 6,500 or so today. And where you've seen that contraction the most is really kind of more at the small and medium-sized kind of regional and community bank level. And so those were the banks that 30 years ago you could walk into and you could get pretty much any financial product you wanted, ranging from a deposit account all the way through potentially insurance and savings offerings through to getting a loan if you're a business owner. But that paradigm really, to a large extent, either has gone away or is going away, kind of depending on where you are in the country. The second factor, and in some ways this really drives the first, is that regulations on banks have gotten increasingly tight, particularly since the financial crisis. But actually, the trend got started before that. But if you think about things like Basel II, Basel III, if you think about tightening regulation from FDIC, the OCC, the Fed, state-level regulators as well, really the net effect of all of those is that banks have to be more careful about what lines of business they're in, and they also have to reserve more capital against certain types of loans than they historically have had to. And small business loans are one category of loans where the amount of capital that needs to be reserved is actually quite high. And as a result, if you're running a bank and you're looking at one lending opportunity where, they're kind of your return on assets can be pretty high because you don't have to resolve all that much, versus small business loans where your ROA is going to be a bit lower, it just is a lot less attractive. And so in many banks' cases, they've just pulled back.
Well, that makes sense to me. I follow the press, and the regulatory level especially is greatly apparent with regard to banks. Sam, a lot of times we hear the word disintermediation, which sounds like it might apply in this case, although I hope we never use the word again in this discussion because it sounds like a buzzword. What's your response to that?
Well, I agree that disintermediation is a buzzword. It's something that a lot of different people kind of claim they're doing as they build a business. So we try to shy away from the word. But I guess the way I see it is marketplaces like Funding Circle are creating new markets in the sense that they're helping borrowers who historically haven't had a great chance to get access to capital or who don't want to get access to capital from banks because of the experience, get that capital directly from individual and institutional investors who are looking for yield. And so, we've created a kind of a new investment category, and a new market in a certain sense. And so to some extent, that is disintermediating at least parts of the existing financial infrastructure.
And it's true, isn't it, that institutional lenders, institutional investors, not including big banks, have occupied a greater amount of the capital supply function, haven't they?
That's absolutely correct. And so what I think you've seen really is a broadening of what we used to call peer-to-peer lending now to a concept that we think about as marketplace lending, where you actually have a diverse set of different types of lenders who are looking for different types of investment opportunity. Some retail investors are looking for really safe, stable returns, and certainly there are opportunities for that, through platforms like Funding Circle. And institutions maybe be looking for something a bit different. Of course, it's really important in terms of how you design a market to make sure that the big guy can't take advantage of the little guy. And we've been very careful to put in place rules of the road so that is indeed the case. But I do think that having both individuals and institutions play side by side is really better for everybody involved.
All right, well then, turning toward accredited investors or other non-institutional types who want to invest in peer-to-peer lending, why should an accredited investor consider holding an interest in a peer-to-peer lending company like Funding Circle or some other company?
Sure. So the way I think about this, and I'm an investor through our platform as well as a number of other platforms out there, the way I think about it is this just provides a great supplement to your fixed income portfolio. The net yields are very strong. Depending on your risk appetite, it can be in the mid-single digits all the way up into the teens. Obviously, as you get more return, you're also taking on more risk, but we do have investors, earning returns in the teens, which is really exciting. And, I wouldn't encourage someone to put, obviously, their entire portfolio in, but if you are looking for an investment product that doesn't necessarily correlate with other things you hold, and if you're looking for a way to diversify across lots of different loans, the marketplace that we offer for accredited investors at Funding Circle could be potentially really interesting to. And so I guess that's why I'm excited about it, and that's why a lot of our investors are excited about it as well.
Correct this question if it's not specific enough, but if you're an investor and you're considering such an investment, what would be the diversification from? I mean, what is diverse from peer-to-peer loan investment?
Well, so small business loans perform in a way that's not correlated with the equity markets to a high degree at least. If you look at kind of a default and loss curve for small business credit, it doesn't track exactly to the S&P or Russell 2000 or any other kind of equity index that you look at. Nor does it actually correspond too tightly to the yields you can get in corporate credit or in treasuries, in actual government-backed paper of various sorts. And so it's not perfectly uncorrelated, of course, because obviously when the economy turns really south, different forms of corporate credit and also small business loans in those sorts of environments perform less well. But in lots of parts of the cycle, it doesn't correspond too tightly, and therefore, on a certain level, it is uncorrelated.
Well, now let's talk a little bit about volatility. If you would describe the upper and lower dollar amount limits of peer-to-peer loan products, so who are your borrowers? And secondly, how do the default rates on your loans compare with similar loans not done through peer-to-peer, if any are still being done?
So our average loan size in the U.S. is about $120,000. And if for an accredited investor who's participating, what they most likely would want to buy are pieces of that loan. So we let investors buy in chunks down to $1,000 increments. So if you had $100,000 in your account, you could actually buy a $1,000 piece of 100 different loans. My encouragement, of course, for my friends who are investing in this asset class is to diversify, because credit risk is idiosyncratic, so you don't want to get too concentrated in your overall portfolio. And what that means is, building a basket of these small business loans over time gives you a really diversified bucket across geography, across type of business, across use of funds. And that sort of portfolio, theoretically at least, should be the most resilient as we move through the cycle.
Let's just take a given sector, say auto manufacturing, which would have been a dreadful sector into which one might have sunk a lot of investment in loans back in 2009 and 2010. Are your loans, again, are the default rates similar to those outside of peer-to-peer lending?
Well, I guess that example is kind of hard, because I don't know of too many very small businesses who are doing auto manufacturing. But I guess conceptually, in terms of how these loans perform, versus bank loans in this category, I guess what we'd say is on the safer end, meaning our A+ and A loans priced in the single digits, that portfolio has and should continue to perform in a way that's very comparable to bank loan portfolios.
Okay.
Now, one of the nice things about being a marketplace is we can actually fund different categories of credit, and we have different types of investors playing. We have some investors who want, safer yield, and so they tend to go for our best loans, and they're willing to accept a lower nominal interest rate. But for folks who want to take on more risk, there is the potential to, maybe make a little bit more. Now, of course, you have to accept more volatility to do that, but there is the opportunity if that's up your alley.
Oh, by the way, I should mention I worked in the bankruptcy and solvency area in 2009 and 2010, and you'd be surprised at the diverse sizes of those who supply to those who supply to those who supply the original equipment manufacturers.
Oh no, that is very true. The
really
supply chain piece was huge. No, I they're very well aware of that. And so no, I think that again it goes back to kind of the point around diversification. I think the scary thing would be if one of our investors put money only into a few small companies that were suppliers to an auto part company that was a supplier to GM. And then you have another 2008 come along, and lo and behold, that that entire ecosystem, to a large extent, gets blown out. That would be really bad. But if you can build a portfolio that has some of that, but it has some restaurants, it has retailers, it has logistics businesses, and so forth, that I think is the best way over time to ensure that you've got a properly diversified portfolio that can kind of weather different climates.
Oh, it's really interesting how you can be internally diverse through this mode of investment. So what about the liquidity of an investor's interest in a peer-to-peer?
So currently, I guess what I'd say is right now it's a hold to maturity product. Most of our loans are around 3 years in term. The range is between 1 year and 5 years. We think that it will be possible to do a secondary program for some of our fractional interests and most likely our whole loan marketplace as well. We just haven't yet been able to roll it out. And as you might imagine, the way you have to do it from a regulatory and compliance perspective, it needs to be really thoughtful and it needs to be really buttoned up. And so it's something we're working on, but it's not yet available.
So acknowledging that, what's your comment on the volume of peer-to-peer securities over the last 3 or 4 years?
Well, the overall marketplace lending or peer-to-peer segment is growing really quickly. If you look at the consumer segment, you've got a couple of very large players in the U.S., namely Lending Club and Prosper, who have grown quite quickly, 100% plus year over year for the last number of years. In the small business category, Funding Circle is the leading global marketplace for small business loans. We've done now about $1 billion worth of lending across the U.S. and the U.K. This year we should do about that much again, if not a bit more. So, the growth rate is quite high, and I think that really just speaks to, number one, the size of markets in which these platforms are playing, but then number two, the degree to which there is really a structural gap that this model can really effectively serve.
You mentioned U.S. and U.K. Are there other places where this presence of peer-to-peer lending is increasing?
Sure. We've spent a decent amount of time kind of thinking about where we want to take Funding Circle next. My job day to day is really just make sure that the U.S. works properly, and I'm going to keep my head down and do that. But we do see the same problem in terms of the structural gap of credit for great small businesses in a lot of other countries, and so we think there's an opportunity to do something similar in parts of Western Europe, potentially parts of Asia as well. Countries where this phenomenon really has already taken root. China is probably the most obvious example. There are on the order of 700 or 800 different peer-to-peer or marketplace lenders in China, some in the consumer space, some in the small business space, and a number of them are really scaled up, doing billions of dollars worth of lending each year. So although we're really excited about the potential in the U.S. and Europe and other places where we can logically go, at the same time, we do think it's a global phenomenon.
As a business attorney myself, I look at the international opportunities for peer-to-peer lending from the lens of the rule of law. In the U.S. and the U.K., when the loan comes up, you have means of enforcing the obligation to pay, which isn't the case with every country. I'm thinking of countries specifically like Mexico, where I've had some experiences. Is that an important factor in the expansion of peer-to-peer lending into other countries?
I think the short answer is, without a doubt, yes. In countries where you either don't have standardized credit information or we don't have the systems and rules to know how you'd actually go about collecting, if someone goes in default, it'd be very difficult for this model to really take root and take off. That being said, in some cases you can price for that risk. So in countries where, in effect, your loans would be unsecured, where, there's not really the ability to force someone to pay you back if they don't want to, you can price out a bet. And so I wouldn't want to rule it out. I mean, I can't speak to Mexico specifically, but we have looked at kind of comparable platforms in different parts of Africa, and some of them have really great models that are working quite well, despite the fact that the legal systems in which they're playing, while developing quickly, aren't necessarily as well understood and kind of fully formed as the common law systems we have in the U.S. and the U.K. So I do think you'll see a slightly different approach or different flavor of marketplace lending take root in less developed countries, or ones where the institutions aren't at the same level. But I don't think it necessarily rules it out entirely.
I was wondering if you could comment on the role of technology in peer-to-peer lending platforms and what changes there might be on the horizon.
So the availability of data is a really important enabling trend for this entire space. I mean, it's really our ability to create a great borrower experience while at the same time doing a really thoughtful, thorough job of credit assessment and risk analytics. That's what makes this entire thing work. And if you were to look back 20 years ago, you simply wouldn't have the kind of necessary infrastructure, kind of again enabling technology to build a platform like Funding Circle. So we think of ourselves as a technology company, and technology is really core to everything we do, ranging from how we onboard borrowers to how we do our credit and risk assessment, to how we do portfolio monitoring and servicing, to the kind of customized service that we offer to our investors. We're really trying to just make it as simple, as transparent, and as fast as we possibly can.
Well, Sam, let me propose something as far as a business opportunity, which you probably already thought of. Funding Circle depends upon information processes to do credit assessment and risk analysis on a large scale with large numbers of borrowers. This sounds like something you could license right back to the banks if they ever got into the business. Have other potential lending entities in various places sought those kinds of relationships with Funding Circle?
It's a really good question, and there's kind of an interesting trend afoot, which is I think this year and over the couple of years ahead, you're actually going to see more and more banks actually look at marketplace lenders and peer-to-peer lenders as partners. In our case, we're in active talks with about half a dozen different banks, and those talks range from them potentially buying loans or parts of loans through us, and in fact becoming lenders through the Funding Circle platform, at least in certain tiers of credit, to conversations with banks where we're going to become a processor, where we actually will help all of their borrowers below a certain dollar size get access to funds, but through the Funding Circle marketplace. Related to that, we have had conversations with banks about out-licensing some of our technology or some of our data, and I think that will be an important piece of how this entire segment evolves.
So I guess you could say that banks fled from an area of traditional lending, and you are bringing them back.
There's a little bit of irony in it, but to a certain extent, yes. And some of the banks we're talking to are indeed commercial lenders today, but what they've realized that for certain types of loans, either in terms of size of loan or type of borrower, it is very difficult for them to make those loans in a cost-effective manner. But at the same time, they may want to offer other financial products to that borrower. They may want to, keep that relationship over time. And so we can provide a really helpful kind of adjacent service that's kind of a win-win-win.
Now, are peer-to-peer companies like Funding Circle, are they anticipating participation of non-accredited investors as investors in them?
So a number of marketplace lenders already accept non-accredited investors. I mean, if you look at how Lending Club and Prosper specifically have developed, they actually do a securities filing every single day. And what that means is their investment program is a product that non-accredited investors can access. In our case, for now, we are limiting the platform just to accredited investors, and that's just based on the way we structure the investment opportunity. And at a certain point, we do hope to be able to offer, the opportunity to invest through Funding Circle to non-accredited. It's just going to take some time again to put in place the infrastructure necessary to do that.
Well, Sam, it has been a most illuminating conversation, and we thank you for it.
Chris, my pleasure. Thank you for having me on the show. And
that's Sam Hodges, Co-Founder and U.S. Managing Director of Funding Circle, a major peer-to-peer lending company. We thank all of you for listening. This is Christopher Cahill on behalf of Accredited Investor Markets Radio. This program is produced by Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.